So this counterintuitive leverage synthetic futures driven silver capping action that we've seen broke out, and I've just seen, so we're now currently at 52.60 and rising. I don't expect the fact that these guys are not going to sit back. They've lost control of the physical markets. So basically what's happening is the COMEX is ignoring, these traders are ignoring these deeply oversold tight physical supply conditions, and it's pricing silver at an actionable discount that is anticipated to force a larger supply short squeeze. And as liquidity providers already affirmed before we broke out above 50, I said it yesterday, sub-spot 50 was ridiculously bargain territory.
You can feel the tension in the silver market building even before you look at a chart. Andrew Maguire has been tracking the cracks in London's system, and he's convinced the facade is starting to fail. The bullion banks have been shuffling paper contracts around to hide just how thin the physical supply has become. For months, they managed to plug the gaps by pulling metal from vaults across the world and narrowing the spread between spot and futures to make things look orderly. But the one thing they haven't fixed is the backwardation, spot trading above futures, and it's sitting there like a warning light. This close to a major options expiry that shouldn't happen unless something underneath is seriously misaligned. Here's the thing, the supply squeeze isn't coming from just one direction. Global inventories are already tight, and now major players are restricting what little silver is available. China has been quietly limiting exports long before announcing any formal controls. The US just labeled silver a critical mineral, a clear signal that access to supply is becoming a national security issue. Despite all that, paper selling has kept a lid on the price. Maguire thinks that lid is temporary. Deep backwardation in a market this stressed is the equivalent of the system shouting that the current price is artificial. It's the kind of setup where the paper market tries to hold the line until the physical market blows straight through it. And he makes one point clear, the opportunity isn't in paper promises. The distortion is giving people one last window to buy physical metal before the real market forces a reset no amount of contract shuffling can hide. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
While the LPMCL, the cartel, had been able to paper over the worst of its real physical silver shortages, assisting in somewhat narrowing this deeply backwardated futures to spot basis spreads. If you remember, we talked about there was the spot was trading at $3 higher than futures, $15,000 per contract above. They're still in backwardation today. This should not be occurring so close to the largest options expiry of the year on the 24th of November. And it illustrates there is still a massive lack of paper supply to meet international facing demand, where paper supply has to be turned into physical. And while these same four LPMCL actors, the cartel, also have a footprint in the COMEX, and they do have a footprint in the SGEI, the international facing Shanghai Gold Exchange hub. And they've raced to ship silver back into London to avert what was definitely a full default. As soon as this bullion lands, it's just drained immediately. That's why we've got backwardations. And as we have identified before, liquidity providers were reporting in capitals, very strong SGE demand into mainland export controls. And while the SGEI silver was shipped out by the LPMCL to capitalize on interim local London shortages, scrambling, these shortages still exist. But so as to not drive the silver prices higher, while they scramble to buy back these ETF shorts way before China and the US officially announced silver was being added to export controls, these restrictions were already quietly being applied by stealth. However, having secured sufficient silver liquidity for the international facing SGEI, the free trade zone exchange to have emerged. It's emerged as the global price setting hub. So Beijing has taken the gloves off, forcing the US to belatedly respond, also officially adding silver to its critical minerals list. How can that be bad for silver? Completely under the radar of siloed COMEX traders, this is, chasing synthetic cash-settled silver warrants from pillar to post. I mean, this is a ludicrous situation. I cannot believe it still exists. This opportunity still exists. And I'm not talking about buying. I'm talking about buying warrants to try and make a profit. What I'm talking about is using this diluted price to stack, to buy physical. So they're just chasing. In the meantime, these guys are chasing it up and down the screen. They look at a moving average. Oh, that's so rearward looking. I mean, we're talking about a time when there was the physical markets were not in control. And they're just chasing, the moving average, let's buy and sell. And what fools. I mean, these export controls into already tight supply and strong demand will ultimately force the price cap to come off. And they're not going to see why. And while myopic silver future specs are run from pillar to post around the rearward-looking moving averages, in the real world, deeply backwardated silver futures to spot conditions telegraph a synthetically coiled spring is ready to release, not necessarily with the speculators on board. So this counterintuitive leverage synthetic futures-driven silver capping action that we've seen, which just broke out, and I've just seen, so we're now currently at 52.60 and rising. I don't expect the fact that these guys are not going to sit back. They've lost control of the physical markets.
Here's the thing. The tone in the gold market has shifted, and the people who usually stay quiet are starting to show their hand. Andrew Maguire points out that liquidity providers have been seeing the same rhythm for months. Every time the price slipped in any meaningful way, central banks, sovereign funds, and large institutions stepped in and soaked up the metal. The tell was subtle but clear. When hedge funds were unloading around 4,000, Goldman and UBS didn't back away. They took the other side and absorbed the flow. That's not trading noise. That's positioning. Bloomberg backed this up with its own reporting. More bullion banks have flipped, even ones that spent years leaning bearish. Toronto Dominion is the standout example. They openly said the slide under 4,000 wasn't a structural failure. It was the last gasp of ETF selling, and that crowd has finally burned through its supply. Now the buyers stepping in aren't chasing momentum. They're building long-term reserves. These are players who care about guaranteed access to physical metal, not quick chart moves. What this really means is the market has moved from weak hands to strong hands. According to Maguire, that transition supports a push toward the mid-4,000s as the year wraps up. Let's get back to the interview.
So direct liquidity provider feedback has consistently evidenced central banks, sovereigns, and institutional buyers coming in. The clue, and if you're looking at, obviously a lot of people are looking at the clues. The first clue was that Goldman and UBS were also reported to be actively taking the long side of the ETF outflows. And spec short sellers that were selling at 4,000, they were taking one-to-one, taking every single thing that was on offer. In fact, Bloomberg's feedback also attests that the widening range of bullion banks, in this case, we suddenly saw a recently bearish Toronto Dominion, who were traditionally fairly short skewed. They were also talking about higher gold prices, and they were assessing that it was the ETF seller exhaustion that took gold below 4,000, and they're openly saying, well, looks like that's exhausted, and that is being replaced by real money, which they are exposed to too. And they're not stupid. They're exposed to real money saying, where can we get gold? They're a bullion bank. Of course, they're going to provide it. And now they want to be on the long side of this. This is so real money is replacing the weak hands. It's seeking exposure to gold from almost a zero level. aggregate estimates still jive, if not far exceed, our 1st of January estimate, fourth quarter price of 4,500. So Shane, this short-term action really leads us into the unfactored, slowly emerging bullish for silver and gold, much, much bigger picture, which is so important to look at. Great, the short-term action. Yep, we're stacking. Great, great, great. But it's what's driving all of this? Now, this Bloomberg piece reveals that Cambodia became the first global central bank to begin storing some of its gold reserves inside the international-facing Shanghai Gold Exchange, the SGEI that we talk about. That's the Shenzhen's bonded vaulting network, basically. And it illustrates that China has accrued sufficient physical market liquidity to take the golden bricks gloves off. We talked about it last time and the time before, openly challenging the Bank of International Settlements, the LBMA, the CME gold market dominance, challenge it. The article also reports, quote, a few other countries have also expressed interest as they weigh the benefits of diversifying their reserves from traditional hubs like London, end quote. Go figure. Now, this report goes hand in hand with a report in September that Beijing was reaching out to become a custodian of all other countries' gold as it seeks to establish a global financial system far less dependent on the dollar and Western centers. And this affirms what we discussed in our last episode. Beijing is actively and openly moving to become a custodian of other countries' gold, providing a full suite global financial system completely independent of the dollar and the related Western control, providing global central banks, sovereigns, institutionals, and traders access to auditably, physically backed, stable storage and trading hubs benchmarked at the 2 high-quality liquid asset fixes per day. Now, excuse the pun, but that trumps the 2 first-tier liquidity local London global fixes every day. Yes, they're first tier, but they're not high-quality liquid asset fixes where the bullion stays on site. Now, Beijing has long set the stage for this global central bank gold storage outreach, enabling direct convertibility of the yuan to gold, gold to the yuan, simultaneously opening up this SGEI Western-facing global gold corridor, which enables global central banks to buy and pledge and trade high-quality liquid asset gold assets in local jurisdictions that are accessible directly to them. That's like Hong Kong and Singapore, and a series, as we say, of planned, and we hear very soon to be launched, SGEI vaults in Zurich, Dubai, and of course, multiple cities in Africa and South America. This is not going away. This is happening.
Physical demand keeps rising from players who rarely reveal their intentions, while the paper side keeps trying to paint a picture that no longer matches reality. When spot trades richer than futures in a market that's supposedly well supplied, that's not a minor detail. It's a sign that the underlying foundation is drying out. Add to that the silent stockpiling by nations that understand supply chains better than traders, and the entire landscape starts to tilt in one direction. Gold is being absorbed by entities that don't flip positions on a whim, and silver is moving into hands that aren't interested in feeding the derivatives machine. You can sense a shift toward assets that don't need permission, don't rely on liquidity injections, and don't care about policy narratives. If this pattern keeps strengthening, the next upswing won't look like a typical rally. It'll feel more like a repricing event driven by people who value ownership over exposure. And once the physical side calls the bluff, the market will have to reveal which numbers were real and which were just placeholders. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for your support, and I hope you enjoy the video.